Good morning. Nice to see you all. And I'm going to be talking about new approaches in behavioural finance. Many of you will have some familiarity with this new area in finance. I want to talk about some of the recent developments. And then Larry Berman will take over and talk about application of behavioural finance in markets. Just in terms of where I come from, Warwick Business School, interestingly, we are just opening our London campus in the Shard, and we'll be offering a number of our programs there on a part-time basis for people based in the city, including our top-rated MSc in finance, as well as executive education programs based on our research for the city. Behavioural finance generates a lot of interest among market professionals, and the question I really want to pose this morning is, can behavioural finance actually help you be more successful in your jobs? And hopefully by the end of my presentation, you'll be able to answer that question. So, what is behavioural finance? It's the first thing I'm going to talk about, and then in rather more detail, what the cognitive psychologists teach us about how we make investment decisions. I'm going to talk about some of the basic principles and some of the underlying theory, and then we'll be looking at some of the direct applications of behavioural finance in practice. I'm going to talk about the area which I know about, which is investment behaviours in equity markets. I'll be talking about how private investors actually make their investment decisions and why they manage to lose so much money. And then I'm going to look at whether professional investors, fund managers, are prone to the same biases. And then I'll be talking about some of the latest thinking in behavioural finance. So, what is behavioural finance? The standard definition is on the slide. We're talking about the application of psychology, and in particular cognitive psychology, to understanding the behaviour of financial markets, and more specifically market participants. In contrast to the traditional finance, which assumes a world dominated by Homo economicus, the Mr. Spocks, of those of you who used to follow the Star Trek films, Mr. Spock is Homo economicus, the Vulcan who was completely irrational and ended up making, if you remember, all the wrong decisions as a result. Nonetheless, in traditional finance, market participants and investors are assumed rational, unbiased, omniscient, and perfect statisticians, and as a result, markets are efficient. On the other hand, behavioural finance recognizes that investors are normal, irrational, and very imperfect decision makers, prone to cognitive errors, i.e., normal investors, real investors, are actually human beings. And what behavioural finance does is actually seek to describe the judgmental errors to which we're prone and the consequences. And the idea is that if we can actually understand how these biases work, then we're going to be in a much better position to correct for these and enhance our decision-making abilities. So, ultimately, are we rational, fundamental thinkers, or is this actually a better description of us, i.e., driven by our emotions? I leave it to you to decide which of those two slides better fits. So, what are the underlying principles of behavioural finance? Essentially, we talk about heuristics, which are shortcut back of the envelope judgments we make, mental shortcuts to reduce the cognitive strain of having to deal with very complex decision tasks. And we're also prone to much more general biases based on how our feelings play out. And another dimension which I'll be talking about is prospect theory, which looks at the way we make decisions differently in loss and gain domains and why we're so loss averse. So let's just look at some questions to illustrate the point. If you look at the slide, the first question asks, what's the more likely cause of death in the US? Is it by a shark, or is it being hit by aircraft parts? Let's just, okay. Who thinks it's a shark? Thank you very much. Okay, good, thank you. And who thinks it's being hit by things falling off an aircraft? Okay, yeah, okay. Well, in fact, it so happens that you're 35 times more likely to be killed by something falling off an aircraft than you are by a shark. But I said shark to start with because it seems so obvious. And what we're doing here is illustrating what is known as the availability heuristic. What we do is we overweight information that is readily available and intuitive. And the probability of an event, we believe, depends on how easily we can remember it or imagine it. And those events which are vivid, written about in the media, are unusual, can be readily thought, are overestimated as being more likely, and those which are less salient are underestimated. So in the case of the shark, this is very vivid. We've all seen Jaws, 1, 2, 3, 4, and I think 5. Okay. This is very vivid. We can imagine what it's like being chased by a large shark. But it's very difficult to imagine being hit by something flying 40,000 feet above us. So we overestimate the likelihood of the shark and underestimate the likelihood, because it's difficult to imagine and we don't normally read about it, of being hit by something falling off an aircraft. Let's just look at some illustrations. When we look at how private investors actually make their stock selection decisions, they're driven by attention-grabbing events. They invest in firms which are written about in the newspapers over the weekend. They follow Jim Cramer, Mad Money program on CNBC, and buy the stocks he talks about. They look for stocks which have experienced extreme price movements, and they buy, whether the stock's gone up or gone down, they still buy the stock. So attention-grabbing events, these are available and immediate to private investors, and this tends to determine to a great extent which stocks they invest in. Similarly, if we think about mutual fund promotion, those funds which are advertised, i.e. they're salient to investors, experience inflows of 20% higher on average than similar non-advertised funds. Of course, these funds which are advertised are those which have outperformed for the past 3 years and are Morningstar rated 4-star and 5-star. But being advertised, these are now known, they're available, and people invest in them. And similarly, when we look at individual investors in the US, familiarity bias in their portfolios, almost 40% of 401k pension fund money is invested in the stock of your own company, which of course is not the most economically rational thing to do for obvious reasons. And also investors tend to prefer firms that are within 100 miles of where they live. So again, you can see availability at work. What about Linda? I want to tell you about Linda. This woman, 31 years old, she's single, outspoken, very bright. She studied philosophy at university, and when she was a student, she was very active in the student movement, concerned with discrimination, social justice, and also very active campaigning against nuclear power. Now, the question is it more likely that Linda works in a bank, or she works in a bank and is active in the feminist movement? So who thinks, A, that she works in a bank, more likely to be in a bank? Okay, thank you. And given that sort of vignette, personality description, who thinks she's more likely to work in a bank and also be active in the feminist movement? Okay, thank you very much. Okay, well, if you stop to think about this, clearly this must be more likely because only a subset of women or people working in a bank will be active in the feminist movement. So logically, of course, when you stop to think, it must be B, but because of the saliency of that personality description, one focuses on being active in the feminist movement and neglects the fact that she actually works in a bank. You can see how this can work if one doesn't think about it. And so what this illustrates is the representativeness, or it's also called the similarity heuristic, shortcut, back of the envelope method of making a judgment. And what this illustrates is how we tend to make judgments based on stereotypes. Linda's a stereotype, and therefore we forget that she actually also works in a bank. And what we're saying is, the way our minds work, we're making judgments based on the degree to which a particular event might be similar to another piece of information. And other factors, such as the more general fact that she works in a bank, are frequently ignored. And Daniel Kahneman, this was the father of cognitive psychology and behavioural finance, talks about this as YCRT in his book. What you see is all there is. So all other information is ignored. And this is, again, a heuristic we're prone to. And if we just look at some illustrations, which what happened in dotcom mania, quite a lot of firms added dotcom suffix to their name, and immediately the stock price went up by 53% on average. The reason is, and absolutely no cash flow implications, the reason was, of course, that investors saw this now as a dotcom stock and immediately repriced it. And those firms which had absolutely no association with the internet went up on average 117%. So you can see representativeness at work. Absolutely no change to their firm strategy, no cash flow implications. So representativeness at work. And what do you think happened after the dot-com bubble burst and firms with dot-com suffixes removed them from their firm names, i.e. they now look more like bricks and mortar, traditional type companies? What do you think happened to their stock price? Anyone like? Well, actually the stock price went up by 60% on average, simply by removing this representativeness of being a dot-com stock once the bubble had burst. So you can see this at work. Analysts are also very prone to representativeness. They tend to, and research shows this, they tend to recommend companies where they like and trust the management. They think that if it's a good management, then it's going to be a good stock, i.e. the stock will go up in value. They actually get the relationship the wrong way round through representativeness. If the stock's gone up, then you think the management must be good. But logically, as a syllogism to actually go from a good management to the stock then going up. In fact, empirically what you find is that you might just as well invest in those firms where you believe the management is totally incompetent as those where you like the management. It makes absolutely no difference to subsequent stock performance. You may feel happier and more comfortable in the latter case, but it's irrelevant for investment purposes. Similarly, another example where one sees this the whole time, the way in which the prior 3 years fund manager performance is used implicitly as a prediction of future performance. And of course, you can't say anything based on 3 years outperformance, however much this is advertised. And of course, in technical analysis, you're very familiar with how representativeness works. The types of things that Kalman and Tversky talk about under this heading, they talk about the law of small numbers, ignoring the size of the sample. And we talked a moment ago about judging skill on the basis of 3 years of fund manager performance. Of course, we can't say anything on this. Representativeness at work. Also, we often ignore other information we know, prior information. This is known as the base rate neglect, statistically. Gambler's fallacy, where we expect chance to be self-correcting. One immediately thinks of this, all the experiments that psychologists have done with roulette wheels. You can imagine they find the random events, but people believe there are patterns vividly. And also random events. Again, psychologists have done a lot of work with students. Why students? Well, they're cheap and available. As to whether they actually can then be generalized is another question. But what they find is that if you give a long sequence of random numbers to bright second-year undergraduate students, they will find the most interesting sets of patterns and then use those patterns to predict the next set of random numbers. So again, you can see how the way in which we're very good at interpreting information leads us to be biased when dealing with random events. Also, we tend to expect, under regression towards the mean, that extreme performance will be followed by further extreme performance. So if a firm's done very well one year, we expect it to do even better next year. And research empirically shows that it's far better to invest in extreme past losing stocks, which, because of regression towards the mean, then tend to revert, rather than extreme past winners, because through regression towards the mean, the price or profitability is going to fall back. Also, we tend to be very confident, illusion of validity, in judgments which are very difficult to make. Stock picking skill is a very good example. We have very good confidence that the stocks we invest in will do well for us, but this has actually got little to do with the ultimate outcome, but much more to do with how much work we've put in, which we confuse with investment performance. Again, illusion of validity. And finally, one of my favorite dimensions in representativeness, ignoring the reliability of the evidence. And when we come to the when we come to the selection interview, this is completely invalid for predicting future job performance. But because of the operation of representativeness, we believe that if we like someone in the interview situation, then they will be good at doing the job. And of course, there's absolutely no connection. In fact, the only thing that has got lower validity for predicting future job performance than the interview are personality tests. So representativeness very much at work. Another question. Dow Jones Industrial Average began in 1896, value of 41. At the end of last year, it had reached 16,600, but it's a capital index. Dividends are excluded. So the question is, if in fact this had been a return-based index with dividends included and then reinvested, what do you think it would have been standing at? Okay. Would anyone think it's between 25,000 and 100,000? Just okay. Thank you. Okay, few of you. Thank you. What about 100,000 to 500,000? Okay. Thank you very much. 500,000 to 1 million. Okay, good. And above 1 million? Okay. Okay, yeah. No, I mean, I knew I'd get this sort of from this audience. I mean, yeah. Fund managers are often quite different, but we'll come back to that. Okay. In fact, the correct answer is 2,310,000. Okay. And if you think about it, the actual capital return is 5.3% a year. Dividend yield is typically 4 to 4.5%. So you're basically compounding at near 10% rather than 5%. And it's just the effect of compounding. So what this illustrates is, which is why I was asking you to make a judgment sort of immediately rather than thinking about it, because everyone would have worked this out, of course, if you'd just sat down for a moment or two. But this is an illustration of anchoring and adjustment. How do we actually make these heuristics, these back-of-the-envelope shortcut decisions? And what we do is we start with an initial value and then adjust to give a final assessment. So you can see how it worked in the Dow Jones Industrial Average example. We knew it must be more, and therefore we added a bit to the 16,000. And, of course, we could add more. But if you think of the budget process, which is a clear example of the operation of the anchoring and adjustment heuristic, in budgets, as we all know, we look at last year under different budget heads. We add on a bit, take away a bit, we adjust, and then we got next year's budget. Similarly, the way analysts make earnings forecasts. They look at current year earnings broken down by regional product. Then they estimate under each of these headings what changes there might be, and then they add up all these segments to get next year's profit forecast. And also the way in which many analysts value stocks. They start with the average industry price-earnings ratio. They then adjust this for risk and whether they like the quality of management or not, they up or down, and then they end up with the forecast price-earnings ratio, which we then back out to get next year's stock price. Of course, anchoring adjustment, there are more sophisticated ways of actually making stock valuations. And typically we're conservative. We don't actually make adequate adjustments. We underreact to new information. And people will even anchor on random numbers and then adjust from there. And what this also leads to is the way in which we end up with very narrow confidence intervals. We start with what we think might be the most likely value, and then we add on 10%, deduct 10%, and then we got our confidence band, which of course is usually far too narrow. Final heuristic I want to talk about is known as affect, and what it basically identifies is the way in which our mental processes essentially feel decisions. Traditional finance talks about us being rational, calculative, i.e. we make decisions. In reality, We simply feel decisions, and then, for example, think of an investment analyst. Investment analyst feels whether the firm is undervalued or overvalued, and then will write a report, in a sense, backing out and justifying this judgment, i.e., it comes after the judgment is felt. So decisions are basically based on intuition, instinct, and gut feeling. What we do is we intuitively feel or have some sense of liking or not liking, goodness or badness. And this is all intuitive. What feels right? And we think of some illustrations, the way in which private investors invest in stocks. They like Hershey bars, therefore they buy Hershey stock. Why do fund managers insist and pay large sums of money to have direct access to firm CEOs and CFOs, paying for access, when in fact they know on one level that such meetings are completely prone to bias? And the reason is, of course, that they want to be able to see if they like these people and trust them, and then they will invest in these stocks. So it's to do with liking as a prime determinant of the ability to invest. And empirically, there's absolutely no relationship between management meetings which are then followed by investment, and whether the stocks actually go up or not. There's no relationship, no empirical relationship with the value of meeting management. Analyst stock recommendations. Analysts, interestingly, trust and like management, and that then leads to a positive stock recommendation, and negative recommendations, hold or sell, where they don't like the management. And this seems to dominate what one might think of as more fundamental analysis of the investment prospects of the firms they write about. M&A deals, many of these, quite frighteningly, are based on affect. It just feels right. And one of my favourite examples is how Daimler acquired Chrysler, although it was put across as a merger. And what happened in this case, Jürgen Schrempp, the CEO and chairman of Daimler-Benz, met Robert Easton, his equivalent opposite number at Chrysler, on the Daimler-Benz stand at the Geneva Motor Show in January 1998. They had a 17-minute meeting, and at the end of the meeting, they had decided to merge. And the justification was, it was a marriage made in heaven. It was an obvious fit, it felt right, between Daimler's engineering skills and Chrysler's marketing ability. Think of that. And in fact, by the time this merger was unwound in 2007, sort of 8 or 9 years later, and Chrysler was sold off, the destruction of shareholder value was no less than 50%, something like $60 billion loss to shareholders was the result of the operation of the affect heuristic. And the large numbers of other M&A deals are based on these seeming to be obvious and feeling right. And also major capital investment decisions, often made by governments, are made on the basis by politicians. It seems obvious and feels right. The NHS IT project, which has wasted 20 billion of our taxpayers' money, followed a meeting in 2002 at Number 10 by Tony Blair with basically a set of computer consultants who were selling the idea. On the basis of that meeting, 20 billion was invested in a system which is now not working, being closed down, simply because it seemed the obvious thing to do. It felt right. and I don't want to be party political, in Duncan Smith's universal credit computer system, which again seemed to be obvious and felt right, is an equal disaster. So again, you can see how affect, this shortcut to judgment, can cause enormous problems. So coming back to investment applications, what the slide says at the foot, and again, affect, careful, pal. I can't do the American accent. You're talking about the stocks I love, and you can see visually the effect of affect, so to speak. One more question. Okay, I wonder if I got a coin in my pocket. No, anyway, I could borrow one. If I had a coin, I would have tossed it, and I would have offered you the opportunity to gamble with me. You're offered a bet on a fair coin. If the coin comes up, you have to pay me £100. There's 50-50 chance. What's the minimum sum you would need to win for heads to come up to make you want to play with me if I had a fair coin? Anyway, so who would play for me for, say, £100 if you win for £100? So you'd have to pay me £100 if you lose. You get £100 from me if you won. Anyone? Yes, some of you. Okay, good. Okay, £200? Okay. £500? Okay. Maybe £1,000? Yeah, okay, fine. Okay. I'm not sure I'm prepared to take that bet on from my perspective. Okay. And who would not be prepared to play at all because of the possibility of loss? Okay, yeah, fair, thank you. Okay, all right. So what we're talking about is the aversion we have to loss. Quite clearly, I should have asked if anyone would have played for, say, £50, but I can't imagine I'll get many takers. But the point that this little vignette is illustrating is how we are loss averse. Clearly, the expected value is 0 if you're playing 50-50 chance, £100 gain, £100 loss. Daniel Kahneman, who won the Nobel Prize for behavioural psychology, 2002, in fact, Nobel Prize in economics, interestingly, part of this was prospect theory, which is what we're talking about. On average, when one plays this game, you find that loss typically has about 2.5 times the impact of a gain of the same magnitude. Basically, we hate to lose, and this leads to get-evenitis. We will not sell losing stocks until they've risen to what we bought them for. We have an aversion to loss. And this then leads to disposition effect. We tend to sell our winning stocks too soon because we are anxious about the stocks then going down. But we hold on to our losers too long, hoping they will go back up. And of course, they carry on going down. The prior losses, what the losses on our portfolio are sunk costs. They should have absolutely nothing to do with what we subsequently invest in. And they should be ignored. But sunk costs are real costs to us. And therefore, of course, traders, market traders, have computer-driven sell disciplines to stop them being subject to this bias. If one of their trades has gone down by 5% or 10%, the computer then automatically closes this to avoid further loss. If one thinks and recognizes that the ability to tolerate loss is key to all investing, then you can understand how Nick Leeson at Barings, Jérôme Kerviel at Société Générale, Bruno Ixel, the London whale, who cost JP Morgan recently $6 billion, how prone they were to loss aversion. And in terms of stock market anomalies, one of the main areas where the market misprices stocks is in the bad news domain, i.e. investors are loss averse, and therefore they will not actually sell stocks on bad news announcements, and so the prices, of course, continue to go down. So really, one's able to make quite a lot of money in those situations where you can actually go short because of the operation of loss aversion. If we look at some other biases, Berkshire Hathaway, Warren Buffett, share price was $18 in 1965. It was $160,000 pretty much currently. The annualized return was something like 3 times the return on the S&P 500. And the question is, suppose you had $160,000 to invest. Would you buy 1 share in Berkshire Hathaway? Would anyone here buy? Okay, right. What we're talking about is hindsight bias. We know he's been very successful, but did we actually know he would be successful back in 1965? So hindsight bias is very powerful. What we do is, of course, have problems of actually going back to our foresightful position, i.e. what we knew in 1965. We think that what we know now, we would have known then. We overwrite our previously stored memories with what we are aware of now, and therefore we believe events were inevitable in foresight, not just in hindsight. And therefore other people's decisions typically may often look wrong now, even though they may well have been totally appropriate at the time these decisions were made. And because we're overwriting our previously stored memories, our foresightful position, what this means is that we are very resistant to learning and correcting for this bias. It is quite insidious. What we also often come across in investment arena is self-attribution bias. I know I'm very prone to this myself. We tend to take credit when things work out, and that is then due to our skill. But when we're unsuccessful, we tend to blame bad luck or outside events, known as self-attribution bias. And when we actually look, for example, at CEOs' letters to shareholders, they will always take credit for when things have gone well in the firm, and they will always find a whole range of reasons which they say is outside their control to explain when things go wrong. If you look and read fund managers' formal reports to investors, exactly the same thing at work. And similarly with investment analysts, when they talk about how they got their stock recommendations right and why other stocks underperformed. Taleb talks about this as the lucky fool syndrome, attributing skill to randomness. And of course, what all fund managers are told on their first day, don't confuse brains with a bull market. Again, self-attribution bias. Very important bias, confirmation bias. What we do is to feel good. We see and interpret evidence in terms of what we want to believe. We know the answer, we look for confirming evidence. And as you can see, this simplifies then very complex decision tasks. We know what's right, and therefore we find evidence to justify this. And we neglect disconfirming evidence. Thank you. Thank you very much. Yeah, okay. Okay. An example of confirmation bias at work. Yes, that's right. Okay. And essentially, what we find is that if there are other people seeing things in the same way, colluding in some sense, then that also becomes confirmatory evidence. And we need to search for disconfirming evidence to get the real story. Janice, groupthink, you're probably familiar with, talks about this in terms of group behaviour, where the purpose of the group is to feel good rather than actually get the right decision. And anyone who might be questioning the consensus feel-good view is ostracised and ignored. So we talk about knowing but not knowing in that sense. And perhaps the most robust finding in cognitive psychology is overconfidence. We systematically overestimate our decision-making abilities. The greater the level of skill required and the more difficult the task, the more overconfident in our abilities we are. The more information we have, the more overconfident. And again, the longer time we spend in analysis, and also the longer the run of prior successful outcomes, the more control we believe we have, and therefore the more overconfident we are. The only problem is that there's absolutely no evidence at all that the degree of confidence is correlated anyway with actual outcomes, which is quite important. Incidentally, I should say my slides will be available on a PDF after the presentation, so if you want to follow up any of these points. And finally, I want to talk about over-optimism, which is often associated with overconfidence. We're excessively optimistic when we predict what we want to happen. And a very good example of this is the Bank of England Monetary Forecasting Committee. In the Bank of England Quarterly Bulletin in December 2013, there was an article which looked at the track record of their forecasting, and the particular case was looked at was the forecast made by the Monetary Forecasting Committee in 2010 about what the UK's GDP would be in 2013 and what the inflation rate would be. So these are top economists. And in fact, the outturn was that the GDP forecast was actually 7% higher than the actual GDP value 3 years later, and the annual inflation rate in 2013 was 4% higher than it was forecast by the Bank of England Monetary Forecasting Committee in 2010. So you can see over-optimism and also overconfidence in work. And very interestingly, self-attribution bias, when they actually started to explain why the forecasts were so out, they blamed the impact of the fall in the pound on import prices, lower exports than forecast, rise in energy prices, unexpected increase in student fees, failure of borrowing rates to fall, and an overestimation of productivity growth, and some other things. So you can see how self-attribution bias, essentially they were blaming their forecast outcomes on bad luck. And we can also look at this with analyst stock recommendations and price forecast. So I want to say just a few things about retail investor psychology from the behavioural finance perspective, and then look at whether fund managers are prone to the same biases. Now, as I've already pointed out, and research evidence is very consistent, these unskilled investors are also called noise traders by academics for obvious reasons. Retail investors are very good at losing money. they trade excessively. The more they trade, the more they lose. But very interesting, they're very, very good at identifying in advance those stocks which will go up and those stocks which will go down. The only problem is that as a class, they tend to buy the stocks that go down and sell the stocks that go up. So if it's possible to know what private investors were doing as a group and actually trade in the opposite direction, we'd all be very wealthy. Men lose more than women, and single men lose even more than single women. The average male private investor underperforms the index by 4%. Women, being much better investors, of course, only underperform by 2.6%. So these are private investors. And why do they underperform? Well, to start with, there's a lot of evidence that we don't, private investors, they think they're investing for wealth reasons, but in fact they're investing for a whole range of other reasons. For example, there's a sensation-seeking activity. And I'll just share with you a very amusing Finnish study where the authors drew on psychological studies showing that sensation-seeking is a stable personality trait, and they looked across risky domains, fast driving, risky sports, and so on, and they looked at speed tickets and stock market investing. And what they found was that for each speeding ticket Finnish drivers got, they invested 7% more in stocks, i.e., similar risky activities. And they found similar results with if you drove a sports car. Again, you would trade much more actively. Unfortunately, they found that there was absolutely no set of personality traits that actually led to any group of their Finnish investors actually outperforming the index. But so there are aspects of sensation-seeking very much in private investor trading. We can call it speculation. Also, a very close relationship between a lot of private investor activity and gambling, and private investors actually tend and like to buy stocks which have lottery stock characteristics or lottery ticket characteristics, i.e. private investors like very cheap stocks, penny stocks. They also like stocks which have got a very low probability of a high payoff, but on the other hand, they've got a very high probability of a low or negative payoff. So these are very much negative investments. How do they actually make their judgments? How do they select which stocks to invest in? They look at charts on screens. They rely on intuition. They believe in stock tipsters and their websites. Also, we've already talked about attention-grabbing events, familiarity bias, and they're also very reluctant to sell their losers. They want to get even before they get out and, of course, lose even more money. Now, perhaps more interesting is, are professional investors prone to the same biases? Do they actually have stock picking skills? And the research evidence is very clear. There are hundreds of studies by academics looking at this. Professional fund managers clearly have a lot of skill, and their funds on average outperform the market before costs. The only problem is that because of costs, the average mutual fund underperforms the index by about 1% a year. And you also find problems in distinguishing skill or ability from luck. Daniel Kahneman, in his book, which I couldn't recommend highly enough, Thinking Fast and Slow, talks tells a story of how he was invited, just to illustrate the point I've been making, to a wealth manager, a very large US wealth manager, to talk to their investment advisors. And he was given a spreadsheet of 25 anonymous wealth managers' performance over the past 8 years. And the performance relative to the index was the main determinant of their year-end bonus. And he had 28 year-to-year correlations in terms of ranking these 25 each year in terms of performance, and then looking at the rank correlation with subsequent years. And what he found was actually the correlation, the average correlation from year to year, was 0.01, i.e. there's no correlation whatsoever. And then, of course, he had to have dinner with the senior executives, and he asked them over dinner, what they thought the correlation would be. And of course they all smiled, thinking this was a trick question. They knew he was expecting them to say, well, 0.8, 0.9. So, well, yes, not so high, 0.4, 0.5. And when, of course, Daniel Kahneman told them it was actually 0, of course, the dinner was quiet. They immediately moved on to other subjects. And the following day, when he actually reported this, when he made the presentation to the advisors in the House, he was rewarded with basically blank looks. The fact that, in fact, their bonuses were completely based on luck rather than skill did not seem to faze them. It's something somehow they denied. And the reason was through the operation of the illusion of validity, because they spent so much time and effort analysing information and coming up with investment judgments. This was far more compelling to them than any evidence about their actual investment ability, even though their bonuses depended on outcome. So, are fund managers overconfident? How do they actually invest when it's very difficult to outperform? Well, what seems to be is that on one level, of course, fund managers have done the CFA examinations, they've done MBAs, had extensive training. They know it's very difficult to do this, but on the other hand, they believe that they, as individuals, are above average. And one behavioural finance would describe this as overconfident. And we've already talked about the illusion of validity. A moment ago, Daniel Kahneman talks about how very bright, very able, well-trained managers actually do use a lot of skill in analysing business prospects, but then the disconnect is that the question is it already in the price? I.e., why should they know better than other fund managers that the business is mispriced? And of course, there's a professional culture which supports this. And of course, superstar managers that investors follow, is it really skill or is it luck? So this is a cartoon that I found. I really don't know if that's fair comment or not, but I thought you might be quite amused by it. Okay. I just want to say a couple of words because actually, fund managers do play a very important role. But what behavioural finance suggests is that the role they actually play, the contribution they make to the clients, meeting clients' needs, is actually a little different. It's not to do with consistent outperformance of an index, i.e. alpha, but much more importantly is to recognise that the real comparator is not the benchmark, but what individual investors would do if they invested themselves. And we saw they lose 3 to 4% a year relative to the index. So they're actually saving individual investors from their own cognitive errors. But you can't advertise that. Buy my fund because I'm going to stop you losing money. if you did it yourself. Also diversification, downside protection, and there's some upside potential. Also, fundamentally, the psychological rule the fund manager provides. Investment is uncertain, it's anxiety generating, and what the fund manager does is provide emotional comfort. The world is controllable. He has broad shoulders. He alleviates the anxiety of having to enter into an uncertain situation. And of course, you can feel good. There's still the opportunity, in a sense, to get the sensation or notional gambling, but it's now very safe because the fund manager is professionally qualified and monitored. And also, if you think about it, one of the roles of active fund managers is actually to get individuals to invest in the first place. And why would anyone really invest in an index fund? Can you think of anything more boring than a passive fund? We invest because there are a key determinant is excitement. Investment is enormously exciting, it's thrilling on a psychic level. And what fund managers are offering is that excitement, and therefore the incentive to buy into this rather than just keep your money, in a sense, under the bed. And even academic experts, a colleague of mine at Cass Business School, Andrew Clare, who was quoted in the Financial Times, you can fly a jumbo jet to New York with no pilot, but I feel more comfortable with someone in the cockpit, i.e. you feel much more comfortable if there's actually someone managing your money than just leaving it to a black box computer. So, a final thing I just want to ask is, do behavioural finance strategies work? Well, investors certainly believe in behavioural finance. Fund inflows into behavioural finance funds somewhere around about 50% greater than into matched non-behavioural funds. The paper, Journal of Investing, shows that behavioural funds actually do very well. They beat the index in raw return terms by 4.5% per annum, and matched, i.e. those with similar style and size, mutual funds by 3.6% per annum. But when you actually adjust for risk, then the returns are identical. So essentially what one's finding is that behavioural finance funds are essentially value funds. They've got a particular investment style. And the question is do behavioural funds actually have a real investment edge, or do they just tell a much more interesting and attractive and plausible story? So, behavioural funds. So, what have we actually learnt? Well, our financial decisions are very frail. I think we all know this, but it often helps to be reminded. Also, the idea is that we can actually recognise some of the biases to which we're prone, and being aware of this, we can perhaps learn to recognise these biases at work when we're making judgments, and as a result improve our decision making. And then the open question is, which of course the holy grail of behavioural finance, can this actually help us beat the market? And many practitioners actually argue it can. Also, we can understand what drives other investors or competitors, and therefore we can perhaps draw on their decision errors in our own investment decision making. We've seen that private investors are very dangerous to themselves, and they should actually be leaving investment to the professionals who are much less prone to bias, and they have very clear other roles than just earning alpha. And the industry somehow seems to be so wedded, this behavioural finance looks at it in these terms, so wedded to this pursuit of alpha, that they actually ignore all these other key contributions. So, finally, don't ignore the key role emotions play in investing. And this is really where behavioural finance is moving, building on the affect heuristic and looking at some of the less than conscious needs, drives and fantasies that investors are prone to. Ultimately, investment is a highly emotion-laden activity, and we may seek to deny this, we may seek to put ourselves and believe that we are able to act in an emotion-free way. We can actually be rational, but what behavioural finance teaches is this, of course, is not actually possible. It is far better for us to actually acknowledge and embrace our feelings, our intuition, our knowledge, and to help us in our investment processes rather than trying to deny, because things which are denied and repressed come back to haunt us. And finally, and perhaps maybe this is one of the key takeaways, irrespective of whether behavioural finance is actually helpful, nonetheless, investors buy behavioural stories. So, I think we've got, just under 15 minutes. The question is, of course, how useful might behavioural finance be in your own work? Max?
Are there any questions? Quite a few.
I'll be around the coffee break.
You want to start?
One question that I have is we have discussions in our company what we provide for our investors.
Yeah.
And I've always said that we provide a way to limit the risk for our customers. However, all of the others in the company is not that big, so it's only 7 people, so argue that we provide alpha. And it seems I can't win that discussion. Can you help me with a good argument?
Yes, yes, people don't want... investment is basically, for investors, in emotional terms, a struggle between the search for excitement and the attempt to avoid the anxiety of loss. So essentially, alpha is excitement. What you're talking about is anxiety. And you can't set anxiety, you have to set excitement. So it's a way, in fact, this is presented to investors. It's really something joint. You're alleviating their anxiety, but on the other hand, providing them with the opportunity for excitement. So I think it's the way it's presented, rather than seeing these as alternatives. Yep. Okay.
Hi. Hello. My name is Bram Stalknecht. I'm developing news analytics. I was lucky that I was an investor in pre-IPO Alibaba. Do you know why they went so well after the IPO, and why they were so visible in the market? And do you have recommendations for future IPOs?
Okay. What you're talking about is what's known in behavioural finance as the fantastic object. And this is a psychological description, i.e. what Alibaba but just go back to dotcom mania. Okay. These were fantasies in investors' minds rather than anything real. And of course, in a sense, wish fulfillment, if we have the opportunity to believe in fantasy as being real, then psychologically we will see this in these terms. So all I can suggest to you is look for other stocks which have got some fantasy dimension and some very plausible cover story, how unreal this might be. And these are going to be the stocks that will be out, that we have 40 times oversubscribed. But don't hold them for the long term.
Thank you, Professor. You highlighted quite a few of the biases and heuristics that I and many, I think, of the people in the room have known to understand over many years. And working for a very large fund management company, there's one aspect, though, I think you did not bring up in your presentation, and that is you mentioned Kahneman's book and many others of which are very extremely well received and very, very good. Michael Malbussen's book, Think Twice, and many of the other readings focus on the process. And as you mentioned, the ability to dissect skill and luck is very, very difficult to do. However, it is possible, I think, with a somewhat disciplined process, as you said, from your takeaways, to kind of learn from these biases and use them to your advantage, which is what tends to happen with experience, and to try to flip them upside down. So your comments on, for instance, meeting company managers, I think in a broad sense might be true. However, if you take the opposite viewpoint when you enter the meetings in terms of being more cynical about it, not looking for the confirmation bias, you actually can provide more of a bull-bear debate and look for the things that would be coming out negatively instead of positively, which is actually quite helpful. So I think the ability, as you said, to understand these biases, look at it from the other perspective, there is a good way to learn from these so-called mistakes and to use them to your distinct advantage.
No, absolutely, I'd agree with you. You're talking about understanding the biases to which we're prone and then guarding against these to actually make better judgments. Yes, absolutely the appropriate use of behavioural finance teaching. Thank you.
You provided a very good summary of the current hardwired problems we face as investors. As a retail investor, these are things that I've wrestled with for many years. My question is, have there been studies about attempts to remediate these issues with groups of retail investors or institutional investors? Have these been done? Are there any signs of success in remediating? I mean, if I was a criminal, I would be a repeat offender in these areas. So.
Okay. Yes. I mean, thank you very much for that. Perhaps I should have actually said that what I'm talking about here, when I talk about the scientific research, these tend to be average groups of retail investors or fund managers, and clearly there are some retail investors who are very skilled, and of course others who just behave along the lines I've described. So this is not retail investors as a class, it's just the average picture. Have there been studies which have actually looked at whether performance improves after exposure to behavioural finance teaching? I think actually the previous questioner made that specific point, that if you know about the biases to which we're prone and very conscious of these, then in fact you can use this in your the judgments you make. Then as to whether this can then be reflected in the performance of the investments you make as a result, ultimately you need very large samples to be able to prove this statistically. But certainly, again, given one of the earlier questions, what it does mean is you're going to avoid making bad decisions which you might otherwise have done, and therefore, presumably, on average, your decisions will be more successful.
We'll just take a question at the front, and then I noticed that some people in the middle are desperately trying to answer a question. We will get back to you after that, I promise, okay?
Professor Taffler, thank you very much for a very interesting talk. I was just wondering, just to be absolutely clear in my mind about what you meant exactly with behavioral finance funds. Do you mean funds which tell a story, or what's your exact definition?
Yes,
please?
the particular paper I was talking about, Wright et al., Journal of Investing, they looked at 16 funds which described themselves as behavioural funds. They were investing on the basis of not recognising biases in the market, which they then, in a sense, were trading on.
Thank you. And one last question. You said how we should not interview people, but do you have a solution of how to interview somebody?
It is very difficult to be unbiased in an interview situation because ultimately you're judging intuitively whether you like someone or not. It's something we've done, we're experts in, right from the moment we're born. We're making these intuitive judgments about whether we like that person or not. And there's a confusion with whether they can actually do the job, which is what you're interviewing them for. All sorts of biases. You make a judgment in the first 30 seconds. You look for confirming evidence rather than disconfirming evidence. The behaviour of the interviewee in this very artificial situation is taken as being how he would actually, if you're recruiting a fund manager, how he would actually do. The best way of doing this is by work sample testing, which means you actually look at how people would do the job in some related situation. And of course, the best predictor of future job performance is past job performance, i.e. hard information on the CV. And the role of the interview then is ultimately, if you like that individual, to sell him your own job. And it's far better to get the personal liking dimension, which is vital in any work situation, by doing this not in this formal interview situation, but informally. So that's actually what the occupational psychologists teach us. I'm not quite sure how it relates. Well, we talked about recruiting a fund manager. Okay. Okay.
Just coming back to the point of how to change behaviors.
Yeah.
If we think about the hindsight bias, it's very deep in the subconscious. What sort of solutions or ideas would you have to change, for example, the hindsight bias, something that is so deep?
Yeah. Skilled investors always write down when they make an investment judgment the reasons they did it. And then a year later, when they're looking at how the investment has played out, they can go back to see the reasons for their decision at the time, and therefore they're in a position not to overwrite because they've got it in front of them, and they can then learn from it. So that's a very good way to debias in hindsight terms. Just keep a formal written record of the decisions you make and the reasons for these.
Good morning, Professor. Could you just tell us what behavioural finance tells us about the track record of somebody like Anthony Bolton? So that's 25 years of 6% alpha on average.
Yes, or Neil Woodford is another example. We don't have the time. But what I do very often is I ask people to pretend they're fund managers and stand up with a coin, toss a coin, and those where it's heads remain standing up, those with tails sit down. Anyway, I think with 200 people, I think one would normally expect somewhere around about 14 or 12 or 14 rounds by the time you actually get one person at the end who's obviously the star fund manager. So you can see how it's very difficult to actually measure skill, even with very large numbers of years, given that, for example, the US have 10,000 mutual funds. So think of how many years of performance you actually need to demonstrate skill statistically. We know of the two individuals we've mentioned have performed enormously well. The last few years, they've significantly underperformed. So is it skill? Is it luck? Because inevitably, there are going to be some individuals who, simply by chance, do very well year after year after year. We only know those individuals after the event. We didn't know Anthony Bolton's or Neil Woodford's ability when they set out in 1977, was it 1988? We only know that now, and in both cases, the last few years haven't been as good as their earlier years.
Unfortunately, we've run out of time this morning, but Richard will be around until the end of the morning tea break, so you better ask your questions then. Apologies, I know a lot of you had your hands up.
Okay.
Thank you very much. A small gift for you.
Thank you very much.